The broadcast is now starting. All attendees are in listen-only mode.
Hello, everyone. I'm Michelle Hebert, Director of Communications here at Saney's, and welcome to another Lunch and Learn in our ongoing Financial Friday series. Saney's is excited to offer these sessions in cooperation with our corporate partner, AXA. AXA has a long-standing presence in New York, and a large portion of AXA's New York client base is built upon the work they do within the public education system. Through AXA, Saney's members can receive competitive insurance rates and a full array of retirement services, including a complimentary financial profile for Saney's members, which we urge you to take advantage of. So our presenter today is Greg Ronenberger, a Regional Vice President and Advisor from the Syracuse area. And before we get started, please note all participants are muted during the session, but we'll have plenty of time at the end for Q&A. And if you have a question, just type your question in the Q&A panel there that you should see on your dashboard. We're recording the session. Everyone will get a copy of the recording, and it will be posted at saneys.org. So with that, I'll turn the presentation over to Greg.
All right, thank you very much, Michelle. And I am Greg out of the Syracuse location normally, but I happen to be in our Buffalo office today, so I'm traversing the state. Happy to be out this way, and I'd love to chat with you folks for a few minutes here on this Roth 403b opportunity, which I think for many of you in many of your districts would be a great opportunity, a great add-on for your retirement strategy. So going to go through a few things here. It should be pretty brief and to the point. We always have to have the legal disclaimers here up front, and there we go. All right, so what we're going to do today is look at, for those of you that were on the tax call from, I believe it was last month or the month before, might be just a little refresher on that, but then look at a Roth 403b and really what the benefits are. So again, as a little refresh for those that were on last time, believe it or not, we are actually paying less in income taxes than we almost ever have been historically in our country. You look at now, this graph shows the top tax rate, individual tax rates over time. And sure, we had a little dip there, but from the mid to late 80s on, certainly a much better tax situation than we were between the say the 40s and 70s or so. So what this is essentially telling us is just that right now we're paying less income tax per dollar that we earn than we had in the past. And sometimes it might not feel that way with these new tax law changes. Some people are telling me, well, hey Greg, I got slammed in taxes and I'm paying in more and I don't know why. And month to month, paycheck wise, you all have seen more money in your paycheck when these new tax laws were enacted. However, the challenge becomes different deductions that some were allowed, some are not allowed anymore. So there are some different wrinkles within the tax code there. But you could see here when the tax laws were established, or the new rates were established in 2018, you could see that the tax rates, where it says tax before credits, that plus percentage number there, tax rates have gone down. So for those making $100,000 in taxable income, you see it's $2,600 less in taxes. And then even at the higher income levels, you could see obviously the numbers are getting bigger there. And the reason this is important is because as we get into what the Roth 403bs are, just taking a step back for a second here and looking at just how these retirement plans work for those that may not have a strong grasp of it here. The employer-sponsored plan that you have, the 403b specifically, even some of you have a 457 or deferred comp plan in your districts as well, they're typically pre-tax funded. So every dollar that you put in comes off of your taxable income, and you tend to save, we always use an example of 25 cents on the dollar. So it would cost you 75 cents to actually invest that dollar into the plan. You get that tax savings up front. However, again, since we're paying less taxes today, tax deferral might be a little less important right now, but maybe tax-free income in retirement could be more advantageous to us. So I look at it as there's an old saying, you could pay tax on the seed or tax on the harvest. So right now, what we're doing with our traditional 403b plans and 457 401k plans is we're deferring the tax on the seed, but we're paying tax on the harvest in retirement time because all that money coming out in retirement is then taxable to us. However, if we're willing to pay tax on the seed, so pay tax on the contributions that go in today up front, then the harvest or all the growth that we get in that account comes out tax-free and could reduce our future income taxes. And I did mention again on the last presentation we did that there could be a situation where we're actually paying more in income taxes in retirement than we are today. But looking at the bullet points here, what it also allows us to do in this Roth 403b option, you can see that for 2019, up to $19,000 can be contributed to a 403b plan, whether pre or after tax. If you are under 50 and then over 50, you could do an extra $6,000. I was actually with a Saney's member this morning, and he was lamenting the fact that, well, I can't do a Roth IRA because I'm phased out. There's income limitations to do so. And I said, well, with a Roth 403b, now you can, essentially. So a nice opportunity for folks that are looking in that area. So again, when we look at the two types of 403b plans that are out there, the way that everyone knows them today is on the left-hand side, that traditional 403b, your contributions, they always say maybe tax deductible. The lawyers always have to put that language in there, but you're deducting your contributions off of your taxes. The money is growing tax deferred, meaning we're not paying any income tax on the interest that's being earned over time. And then we're paying tax on the withdrawals that come out, and then certainly beneficiaries, if we're concerned about leaving the money to our heirs. I say my kids will get what they get. I don't care if they pay taxes, but some people want to limit the income taxes that their beneficiaries will pay. So they do have to pay tax when it gets inherited. The Roth side, again, it's paying tax on the seed, so the contributions are on an after-tax basis. So people need to understand that if they just go cold turkey and say, well, I'm going to go from a traditional to a Roth 403b, and you're doing, say, $5,000 in contributions to your 403b today, putting $5,000 in the Roth 403b is going to be out of your taxable income. So you're not going to get a tax deduction then on the money that you put into the Roth today. So that could cause someone to say, well, all right, I switched to this Roth 403b, but I paid a lot more in taxes this year. Well, certainly that could happen if that's the case. But the earnings will grow tax deferred as well, and then we're not paying any taxes on the withdrawals when they come out. So if I have $10,000 in my 403b that I'm taking out, if it's in that left-hand side traditional 403b, I have to withhold 20% income taxes. That's a federal requirement. It's nothing that any of the investment companies want you to do necessarily, but the feds say, all right, if you're taking money out of a traditional 403b in retirement, send us 20% and you get the balance. So if I want to get $10,000 out of my plan, I have to take a distribution of $12,500. $2,500 goes to the U.S. government, and then $10,000 comes to us. Whereas on the Roth 403b on the right-hand side, if I want a $10,000 distribution, I just take out $10,000 and I don't have to worry about adding any income tax to it. So that's the basic difference there from an example standpoint as far as what a paycheck would look like. Here's an example of Lisa putting in $200 into her account. And this is just a simple way of stating that, look, your contributions are going to be the same into the 403b plan, whether it's Roth or traditional. However, the take-home pay reduction, if you do it again out of a Roth because it's an after-tax contribution, it's going to feel like $200, where right now, someone putting in $200 per paycheck or per month is going to feel like $150 lost in income, because that extra $50 is what we would normally pay toward income tax. But what are the benefits of a Roth 403b? So why would I do this versus a traditional one? Well, there are a couple of reasons why it might make sense for you. Number one, again, we're understanding that we're giving up a tax break today, but some people look at their situations and say, well, you know what? I may pay about as much or maybe more in income taxes in retirement time. And how could that happen? Well, again, we add in pensions, we add in different retirement plans we might be distributing. Let's say that I am a school vice principal and my spouse is working for a corporation, and they will have a very large 401k plan that they're distributing income from in retirement time. Well, all that money coming in is going to be taxable as well as my pension will be. So any additional 403b money will be taxable too, and I might have a decent amount of taxable income there. Or maybe I inherit money in retirement time and have to pay tax on that. So if you're looking for a tax hedge in retirement, this would make sense for you. If you're looking at being in a lower tax bracket in retirement, so someone who says, you know what, I'm really not going to have a whole lot of income in retirement time, and I might pay maybe 5–10% in taxes in retirement, but I'm paying 20% in taxes today, then a pre-tax or a traditional 403b would make more sense for you in that regard. We do look at age as a consideration. It's not the only consideration, certainly, but typically younger individuals tend to benefit more from a Roth contribution than a traditional contribution. And the reason is that as the younger individuals, they're not at that peak earning years yet, where they're just maybe starting in administration for some of you folks, and we're not at the real high levels of income that some of our counterparts that have been in the system 20–25 years are. But again, the earlier, and you'll see this a little bit later, but the earlier we start, the more growth we'll have, certainly, and it gives us a lot more tax-free earnings in retirement time as we have longer for that harvest to grow, so to speak. And again, I mentioned people that aren't eligible for Roth IRAs right now, that are phased out from an income tax standpoint, but say, you know what, I want to have some money in a Roth, in a tax-free environment. This allows them to do that here. So in looking at this slide here, there's a lot of busyness on here, but just looking at the numbers over on the side there, what this is stating is that, let's take the upper grid on the right-hand side. It says number of years, and you go out, say 20 years, there's $116,000 in an account, let's just say. Well, the after-tax net earnings, what it's saying is that if we're taking out a distribution from the plan, if we're just taking out the interest on the plan, that's $6,600 that's tax-free that we're able to take out. Okay, so the amount in our pocket from that account is $6,600, where if it were taxable, it would certainly be less than that. So that's really all it's saying right there. A lot of busyness in stating that. But here's where the starting early example comes into play, and sometimes this is kind of a double-edged sword to show something like this, because then someone at age 45 says, well, gee, it's way too late for me to do something right here, so I won't even bother starting. And that's not really the message we should be taking away from this. Personally, I'm right in the middle of that 40 to 45 range, and I look at that and I say, you know what, I should start saving more money into this thing as well, because wouldn't I love to have that $500,000 tax-free retirement? It just means I need to save a little more today. But the reason we highlight this is because there are individuals out there that aren't saving anything, that are in their 20s and 30s or so, and hopefully no one on the call is in that boat, but that is the case, and people in your buildings are in this situation as well. But where someone says, well, gee, what would I need to do to get $500,000 tax-free in retirement? If I'm 30 years old there, then at age 65, if I put in $276 per month into a plan, you see my contribution's $115, but my growth is $385 or $384. That gives me $500,000 in tax-free income. So again, in this Roth contribution, what I've done is I've paid tax on the $115,000, but I get the $500,000 tax-free. Whereas in the reverse example on the traditional 403b, that $115,000 would have been tax-free to me, so it would have cost me a little less today, but I paid tax on that entire $500,000. So that's a difference there. So that's why we look at someone who's, let's say, 50 years old down there and say, all right, your growth would be less than your total contribution. So does it make sense to pay tax on the 282 and get the 217 tax-free? Or would it make more sense to pay no tax on the 282 and pay the tax later? So all different considerations that we take a look at for folks, but just wanted to highlight really the benefits of starting early for some of you folks out there, whether it be for yourself or coworkers, or even many of you may have children that age as well. One thing to keep in mind when people think the the mindset is typically, well, don't we always pay less taxes in retirement? And I would say maybe or maybe not, but one of the things we have to look at is what will tax rates look like in retirement? What will they look like 20, 30 years from now? Will they revert back to those 50, 60% highest effective tax rate that we saw on the slide earlier? We don't know. Somebody has to pay the bill that's going to come due for all these tax cuts. And maybe it'll be us, maybe it'll be our kids, who knows. But keep in mind that this new tax law that was initiated in 2018 that lowered all the tax rates has a sunset provision in 2025. And what that sunset provision states is that if whoever is in charge of the country at that point in time, so whoever is in office in Congress there, if they decide, you know what, we never really liked this tax provision that this one party put in place, and now a different party is in charge there, so to speak, and they say, you know what, we're not going to renew this. Well, it could be that we go back to what it was in 2017, where the tax rates are higher at that point in time. So that's why we say, you know, we don't really know what it's going to look like come retirement time. So we want to make sure that we have a hedge against there. And then just really having a tax diversification strategy in place, because we may want to look at having different buckets in retirement to choose from. So maybe I take my monthly draw out in a taxable way, but if I want that $5,000 for the vacation, or I need to take some money out for gifting, or for whatever purpose, wouldn't it be nice to have a tax-free bucket in retirement as well that I could pull from, so I don't have to worry about paying additional taxes? So those are some of the strategies that we definitely talk to folks about. Some additional benefits for this Roth 403b account is that as long as we're working, we can make contributions to the plan. So that's nice to see. We don't even have to be working full-time. We could be working part-time, but we do have to be working for an employer in order to do that. We could have both, and that's really nice. And it's one thing that I know we at AXA do. I can't speak to all the other different 403b providers out there, but if I have a pre-tax 403b and I want to add an after-tax Roth 403b, I could do that, number one, at the same time, and I could also do that all in one account. So our AXA accounts actually hold both pre-tax and after-tax 403b in the same account, which just makes things a lot easier for people down the road. Now, one thing that people will ask me is, well, hey, I'm maximizing my pre-tax 403b. Now you're saying I can maximize a Roth 403b as well? And no, the 403b limits are inclusive of both types of contributions. So if I'm putting away the full, say, 19,000, or if I'm over 50, 25,000 into a pre-tax 403b, I don't have room for an additional one. But if I'm doing 6,000 into my pre-tax 403b and I say, you know, I've always wanted to do a Roth IRA, but I can't. Well, now we can in this 403b. So maybe I add another couple $100 per paycheck in a Roth 403b, have them all together in one account. We stated that withdrawals are not taxable. And when we do retire, we can do a rollover of the 403b into a Roth IRA if we wanted to do so. And there are some advantages in doing that. And it's where the second bullet point on this slide is because the 403b plan does require us to take out minimum distributions at age 70 and a half. There's a law looking like they're trying to pass some changes to the retirement landscape here, looking at maybe increasing that age to 72, which would be nice for some folks where we don't have to take out money until age 72, but right now it is 70 and a half. So if it's in your Roth 403b, people have to take that money out at 70 and a half, but if we roll it to an IRA plan, we don't have to. So there's one of the benefits there. A little bit easier to transition dollars to the next generation if it's in an IRA plan. So we definitely look at that. And then for those that are looking at the loan opportunities in the 403b, which a lot of times we need to take advantage of those, the Roth account balances are included in there as well. What I would suggest is doing a couple of things. It's tax season right now, just about done with tax season right now. So if you have your tax returns or you're getting your tax returns back, I would definitely recommend sitting down with your advisor or reaching out to us if you need some help and taking a look at the 2017, 2018 income tax returns, seeing the difference that the new tax laws have created there and seeing what the opportunities are. So are there opportunities? Some people, like I said, actually paid more in taxes or felt like they paid more. They got less of a return than they did in the past just because of the way the different tax laws and deductions look like. And they said, hey, I don't need this extra money in my paycheck. I'd rather not pay this extra tax down the road. So maybe you do look at a traditional 403b from a tax saving standpoint today. But maybe you look and you say, wow, I did pay a lot less in taxes, and I think maybe this after-tax strategy would work. But having those two different 2017, 2018 tax returns right there side by side is a tremendous help in looking at tax strategies right here. Also, it doesn't hurt to take a look at your investment portfolio as well and just make sure that everything's on the up and up there. It's definitely nice to see. And hopefully it allows you to, if nothing else, at least put you in a better mindset, make you more comfortable with the decisions that you have going on for right now. So I would say the last thing that I would suggest you do is take a look at your plan, call your payroll office or your benefits office, because a lot of districts still do not have this Roth 403b option inside their plan. And in my experience, when we talk to people about it, and I've talked to superintendents, to business administrators out there, and they've said, yeah, well, why wouldn't we add this in, Greg? And I say, there's really no reason not to. It benefits everyone. It doesn't cost the district anything. So there might be a nominal fee if the TPA charges a fee to update a plan or something like that. But what I'm seeing is that they're not even doing that. They're just saying, yep, we'll flip the switch. We'll go ahead and turn it on. So ask if you have one. If you don't have one, just ask for one. And tell the district and go to your counterparts, the people in your unit, and say, you know what, hey, we want this. This is a benefit to everybody. Some districts I've seen have actually said, well, okay, if the admin unit wants it, then they have to put it in on the bargaining table. It's really not something that should be bargained in your contracts because, number one, again, it benefits everyone in the district, not just your unit. And number two, it doesn't cost the district anything. So it's not really a bargainable thing, I don't think, would be my recommendation, is just say, hey, this is something that will help everyone. I think we should definitely do this. So that's pretty much everything on here, Michelle. It's a shorter topic. Just wanted to get a couple of ideas out to your folks there. And I'm definitely happy if there are any questions that were in the chat. Happy to take those. I apologize, don't have the contact information on here, but my phone number, if anyone wants to reach out and call, 315-425-6334, and easy enough to find if anyone just needs to contact Sainies and get our information to walk through some of the stuff. We're happy to do so.
Sure. And when I send out the email with the link to today's presentation, I'll include contact information as well. But for now, we don't have any questions in the Q&A box. So last call for questions before we log off. All right. Well, I think that's about it. Thank you, Greg. And watch for the email, everyone, and have a great weekend. Bye-bye.